Welcome back to Golden Rule Radio, your first show of the year here in 2020, coming off a couple-week hiatus. Enjoyed some time away, but we're glad to be back here with you, kicking off the year with some fairly exciting news. You know, January 2nd started out great. January 3rd, Australia is on fire, and by January 4th, we're taking shots at Iran. So definitely starting the year out strong.
With a bang.
Or at least with a bang.
Pun intended, I guess.
Very specifically pun intended.
Now, thanks for your patience with the end of the year, because we did take the pause, and there was precious metals action before January 2nd.
How about that? Gold pushing up to about 1585, taking a little bit of a breather until this week, finally breaking that 1600 mark at around 1611 and then reversing back down. So that puts us into that last right shoulder going all the way back to 2012 and has definitively been the line in the sand since we broke past 1375. So should see some pretty aggressive movement, some volatility over the next couple weeks, and I wouldn't be surprised to see gold take a little bit of a breather here.
And before we get into the technical analysis this week and this whole recap, I do want to close out 2019, because during the last show, we didn't know what the end of the year was going to look like. So briefly, got to mention, gold finished up 18.5%, silver finished up 15.4%, and platinum strong 22.3%, but it obviously pales in comparison to palladium's 57.2% rise in 2019. So there's the end of year numbers for you for 2019. Solid for the portfolio, and most encouragingly, the precious metals reacted the way they should have with all of the fundamentals and technicals in the market.
So depending on how long you've been listening to our show, if you have been listening for a year or two, you'll remember that we have a call to action back in April, May. Gold was around $12.50 back then, $12.70. And in May, before it launched, we said you need to be buying. And here we are, $300 higher. So I have to reiterate last year's point of call to action being on the buying end of gold proves to be true. And here we are in the mid 1500s. If you listened to us in December, you would have heard us tell you that end of the year should be good, and it has been. So we've seen what we expected to see, guys. I think, a good strong move in gold pushing us to the 6-year high where we are, and we expected to see the first part of the year be good for gold, which it has. It even kind of, I guess, front ran the end of the year, move higher. And where we're headed from here, we want to talk about that.
Well, unfortunately, Robert, another prediction that we stepped out boldly in December, and that's not our nature necessarily, but we did say be prepared for a conflict. You know, with everything going on from an impeachment standpoint, geopolitical tensions building already, and then negative economic news, we just said, look, the normal MO here is all of a sudden a conflict arises. And that's unfortunately happened within just the first month. We kind of felt like it'd be within the next 6 months. But anyway, that's been part of the gold's action. Let's throw the chart up here, Miles, and you run us through the technicals.
So with that said, again, looking at that right shoulder, that kind of last-ditch effort back in the beginning of 2013 when gold tried to continue that climb between 1600 and 1900 and then fell. So these are the prices we've come into now, and it's very expectant to have gold see some pretty serious resistance at this level. So to see some volatility, I wouldn't be surprised to see a fist fight here between the bulls and the bears. My gut would say the bears end up winning short term, and we do end up seeing a better opportunity here coming in the metals price.
Yeah, I think it's encouraging to note also that we did today, Wednesday, while we're recording, gold did penetrate 1600 very clearly. It didn't just pop to 1600. It went to like 1611 or so. So that psychological barrier has been penetrated, and a pullback here is obviously due. I don't know how shallow, though. The stair step higher with gold has been in a lot of the case where the pause is just kind of a pause and it trades sideways. So I do expect gold to continue up, whether it just trades sideways here and consolidates or possibly has a little bit of a pullback. I'm encouraged that we're in the time of the year for it to move a lot higher. And so if you are looking at adding to your ounces or positioning, you don't want to wait too long because it is going to leave you behind. But we do expect some good opportunity here in the next few weeks.
I would say, too, that from the 1611 down to the 1555, which is where gold is as we record here, that's a big pullback, but that's 100% due to a calming in the markets, a calming in the sentiment. The president came out and gave a speech this morning. It was very pacifying in terms of no expected retaliation to the Iranian rockets. And so you should expect that big pullback, because that's what the big run was last night, right? It wasn't predicted by us, and it wasn't expected because you don't know that Iran's going to fire rockets. So for it to come back down here is healthy. We're right back where we were before last night's news. We're in a strong bullish territory here, are we not, Miles? I mean, 2019 was that way, and we started this climb before the end of 2019 into the first week. Last night, to me, is an anomaly.
Well, and the thing about markets like this, the general public who maybe doesn't follow price movements on a day-to-day, week-to-week basis may look at something like a pullback all the way to the old highs, 1375, which is still exceptionally bullish to come back to that level, really pull the drawstring back to let go, may scare a number of people. So with what you said about the Iranian issue, I will again, Robert and I are smirking at each other because, as I always say, the fundamentals, all they do is they drive the price to the technical levels either faster or slower than they would have in the first place. So technical levels always get reached and they always end up holding. And the reason is that's because that's where you've got institutional money with orders standing. So no matter how hard you push the price up, eventually it ends up hitting a ceiling where you've got a ton of sell orders, or vice versa. Price goes down, you got a bunch of buy orders. So that's kind of the fun thing for me. Anytime you see this type of political event, geopolitical event, war-related event, it's going to just push the price up faster than it would have done otherwise.
To the same support or resistance levels. And can you show us those levels here? Just lay them out.
Yeah, so we'll throw a couple on the charts here, but obviously you've got this big one we just hit that we've pointed out, that right shoulder. We come back today after hitting that, back to that 1555, 1560, which was the high from the end of last year. You know, your next step down would be that previous low, which we hit in end of this past year, you know, mid 1400s. And then obviously I'd still love to see that push all the way down to the old high, that 5-year high at around 1375. For me, that would be the best case scenario, obviously best case scenario entry point for the next leg up, which starts challenging those $1,600 to $1,900 highs from 2011. So moving over to silver, we get a slightly different picture, even though silver's up. Still kind of waiting for something to happen here, guys. What do y'all think?
Yes, silver's followed gold, but it hasn't had the breakout yet. The gold has.
Yeah, the ratio has been stuck at 86-1, so it did fall. Even last night with gold's climb, silver went to 1870, and here we are right back into the low 18s.
Right, and I mean, you're looking at extrapolating back to the last major run-up in gold, silver, and the like, 2010 to 2013, that last right shoulder of silver is up in the mid-30s. So obviously silver has a heck of a way to go to play catch-up just to match what gold has already done over the last couple years. So I think this is a good place to point out that even though silver continues to lag, and we'll look at the same between platinum and palladium, even though platinum continues to lag palladium, it's just, how many times are we going to use the word opportunity, right? I mean, silver is still the thing that I am desperately interested in for my own portfolio.
Yeah, anybody that acquired silver or platinum last year at our recommendation, again, going back to it, silver's up 15% last year. If you put that in your IRA, you're happy. If you put platinum in your IRA at our recommendation last year, because of its undervalued nature, up 22%. So again, we're not just looking for performance. To Robert's point, we're looking for things to just stop being tied to each other and one outperform the other so that we can see these ratio trading opportunities. So on top of that performance, we're going to get compounding ounces. But yeah, platinum seems a little ho-hum, but still doing great. All the white metals are having a great streak.
Sure, well, 20-some% is ho-hum comparatively, right? And I think that's the point, is it's the comparative values of these different metals. So looking at the last two, platinum put in a second top, similar to where the August high was. We hit that again almost to the penny, and then have reversed back down. But same as silver, you need platinum to be breaking out of these multi-year highs, which it just hasn't done yet. So gold's leading the charge. I think, taking a snapshot of these different markets in the metals, I think that brings back in the fundamental discussion of this is not the general public buying metals. This is central bank buying. 2019 was the largest central bank acquisition of gold around the world of, I believe, any year previously.
Yeah, the previous high was 2018.
Yeah, and then you go all the way back to when Nixon took the dollar off the gold standard in 1971. So central banks obviously see some kind of turmoil coming, and instead of just investing in their own currencies, they're buying gold. So that should tell you something. I mean, that's why gold's turned bullish this last year and should continue. That's what I see in this coming year.
Well, they're not just buying gold. They're in a panic mode with pumping liquidity into the repo market. So another $99 billion in the last 3 weeks, you guys. That's like mind-blowing. Wow. We're approaching $600 billion. And again, it's all behind the scenes stuff that takes no accountability to anybody, just adding to the balance sheet. So you're right. Buying gold, pumping money, liquidity into the repo system, they're telling us something is awry.
Finally, we'll throw up the Palladium chart just to have another gander at what Bitcoin looked like a few years ago, because Palladium now sitting firmly above 2,000.
And rhodium pushed up to like $7,000 an ounce.
Right, but rhodium's still about 3,000 off the high, isn't it?
Right.
Because it did break 10,000?
Either right at it or broke it. But yeah, it used to be 10,000 and then crashed back down to like 500, and now it's back up to 7,000, 7,500.
Right, so rhodium actually may still have some room to go to retest those old highs. So moving over to equity, we will point out, after the Dow did manage to put in a new high there at the end of 2019, we are seeing a fair bit of volatility bouncing around, and it does look like it's starting to compress a little bit. I don't think the Dow is done, but I personally am looking for a few entry points short here. Even if we're not looking at that big 40, 50, 60% crash like we had in 2008 quite yet, although it's starting to smell like that's possible, just throwing that out there. Any type of correction here, I think you could see some advantage taken if we have the market turn back a little bit.
I think it'd be helpful to point out to people who are invested in an equities portfolio in that your year-end statement is going to show as if your financial advisor did really, really well for you, because the start of last year, the equities market was in the tanks. It was starting from such a low point after the fourth quarter of last year decline that your year-end number for 2019 is going to show a very strong gain. But if you look at it from the previous high of the end of the third quarter in 2018, where it then fell
19.5%.
Right. So if you just look at your year-end statement, if you're in an equities position, I think it's a bad picture to actually measure your performance there. So just a note.
Robert, that's actually a key point, because it shows to be a gain of approaching 28%, when in reality, it's about 8.6%.
Right. It's more like 8.6% from where you were last year. Instead, because the equities market was so low at the end of, or at the beginning of this past year, then the year-end statement's going to show a ridiculously high number, which is giving you, I think, a false picture.
Sure, you'd have to go back to the middle of 2018 where you put in the previous high.
Correct. So just something to consider when you're looking at the year-end numbers for gold versus the equities market. Don't let that year-end statement for your equities position give you a false sense of confidence.
You bring in the Dow theory to that, and you see that the transport average still hasn't done anything. I mean, it's been locked in this sideways pattern for a year, ever since that December 2018 fall.
Failure to confirm.
Exactly.
Bullish,
and has
correct.
Never come anywhere near the previous high like the equities have. So you know where the leveraged money is going into. It ain't going into the railways. It's going into Apple and Facebook and Amazon and the likes.
Tesla. And, Tori mentioning the repo market and all the money that's coming in there. I mean, the market moves higher because it likes that type of behavior from the central banks.
So one last thing, moving over to the currencies, because I think this definitely brings back in what we have hinted about over and over for the last couple months, and that's this new repo bailout program, and I think you can see the effects of it on the chart. So where are we at so far since inception in September?
Well, I mean, when they got going, it was supposed to be just a few billion here and there going on for the full first quarter into the second quarter of 2020, but they blew through that. So like I said earlier, we're approaching 600 billion now on this, with 99 billion done just in the last 3 weeks. But from inception through the middle of December, it had already hit that 500 billion mark. And that wasn't supposed to be the case for the entire program's duration. So we'll see if this continues. At this pace, we're going to hit $1 trillion. And where in the world does that come from? That's for a previous show that Robert broke down the value of $1 trillion in.
Right. And the reality about this that I think we all need to realize is, even though in the long run this is adding some rampant inflation and additional currency into the system, the short-term reality of this is because there is a worldwide global starvation for liquidity. There is a desperate need for dollar, and I think that's why you're seeing the dollar rising right now since the end of 2019. Do keep aware that even though you're seeing these numbers, and you may be asking the question, why is the dollar going up if they're pumping so much into the system? And the answer is because they're going to have to continue to pump it into the system. Every time it comes into the system, there's a buyer out there willing to pick it up. So, and we're seeing that reflected. The dollar has rebounded since the end of 2019, continues to climb, and even though it had actually looked like it was breaking down below that multi-year rising channel, it looks like we're pushing back up into it, and I actually think we're going to climb a little higher on the dollar index. Vice versa, the euro has been coming down since the end of 2019.
There's your reason for the dollar too. It's because every currency is injecting capital into the system. They're all money printing. So go ahead.
So between the economic pressures, between the need to keep the equities market afloat here, moving into tax season, moving into IRA season, additional money coming into the system to bail out not just U.S. but international banks in this overnight repo market. Add on top of that an election coming up this year with the sitting president who just went through the impeachment process, and what's going on in the Middle East, increased Iranian tensions. I think it's going to be a fun 2020, guys.
I do too. All eyes too on corporate earnings reports as they come in over the next week or two, and how that affects the equities markets and gold responding accordingly.
That does it this week for Golden Rule Radio. Happy New Year. Thanks for listening. You can follow us on Twitter at ICA Gold, like us on Facebook, McElvaney Financial, call us at 800-525-9556, or visit us online at McElvaney.com.
Thanks for listening.
Have a great week.